Well, it's time for another edition of the Rogers Capital Monthly Market Commentary, where we attempt to be the antidote to water cooler wisdom. After a pretty strong start to the year, at least through mid-February, we were up 4% through the second week of February. We've now given all of that and then some back, now down year to date about 15%. So plus 4 to negative 15, down 19. Quite a bit of downside volatility here. Markets really getting surprised by the Trump administration, especially in the last 2 weeks or so. Tariffs more aggressive than even, I think, the most pessimistic projections had assumed. The retaliatory response from China and at least planned or suggested, that Europe will do the same. From a stock market perspective, we're past peak uncertainty, now into pessimism territory. But tariffs, tariff rates should go down from here as negotiations begin. Interest rates should head lower as the deficit narrows. Oil prices have come down significantly, the lowest gas prices we've seen in over 4 years. We're at $60 a barrel and below, actually, West Texas Intermediate. Tax cut extensions become more viable, maybe even broader tax cuts, and make them easier to pass given the tariff revenue, potential tariff revenue that may come in to offset some of that. There are several potential silver linings in here. Number one is that corrections like this very often offer attractive buying opportunities. Okay, that's number one. Buy low, sell high, right? Number two, Trump clearly is open to negotiation here. In fact, he is asking for it. And seems like most countries are lining up to do that. And he can act fast. I mean, this is stroke of a pen stuff. In fact, it's like a tweet even that he can send out to affect things. Number three, there's a Trump put in here at some stop in here at some level, with recession more and more likely, flirting with the bear market, and certainly if that occurs and then deepens, and actually we may be even close to it right now, where Trump says, "Oh, okay," and begins to signal a reprieve to what's caused this, primarily these aggressive tariffs. Number four, recession's probably more likely than not if high tariff, especially extended high tariff rates hold. China back and forth, Mexico, Canada. And that brings the Fed into play. Fed rate cuts. We have actually gone from an expected 2, you've heard this on these videos, 2 cuts in 2025 to now the market pricing in 5, likelihood of 5 cuts this year. And that's good news for investors as rates get cheaper. It's actually also something Trump has kind of been at war with the Fed about. So that's the fourth silver lining. Market doesn't necessarily care about these silver linings right now, Wall Street. But that's fine. At these levels, we don't need much good news. We just need less bad news, okay? Now, when will this end? When, will this downside, pause? When will the rebound begin? What will it look like when that occurs? Well, we got a little glimpse of that on Monday morning. We had an erroneous headline suggesting the Trump administration would issue a 90-day reprieve on tariffs. That drove a sharp rally in stocks that lasted about a half an hour until it was disproven. an 8.5% swing up, rebound up in the S&P from 8:45 a.m. Central to 9:15. And what does that tell you? It tells you that maybe this isn't a fundamental, crisis. This isn't the dot-com bubble of 2000, 2001. This isn't the financial crisis. This isn't the pandemic. This isn't something so structural. In those cases, you didn't have 8.5% midday, 30-minute swings in markets. You have, I think it tells you, Wall Street looking for something, some help, and ready to pounce on it. Okay. Second thing to notice is what led that rally. Growth stocks, tech stocks, that's what led. And we can look at, that's what's likely to lead when markets recover. Of course, we don't know when that will occur, but it's fair to say that these sectors that have been beaten down the most, which rallied hardest when it looked like that Trump might ease up on tariffs, that those will be the names that make up the most ground when we move back to fair value on the markets. As these negotiations progress, as Trump maybe relents with some of these tariffs. Okay. Now, some historical perspective for you, some numbers for you. We're not in bear market territory yet, at least as I make this video here, 7:30 in the morning on April 9th. We're not there yet, but if we slip into bear market territory, what should we expect? Well, stocks tend to do well once a new bear market starts. We have had 11 bear markets since 1950. Modern era, last 75 years, 11 of them. And the average return 1 year after we slip into bear market territory is a 15% gain. 1 year later, plus 15. 2 years later, 27.5% gain. So, a little perspective in that history as well. What will we see this time? We'll have to wait and see. That's it for this month. We'll talk to you next month. As always, feel free to reach out if you got questions about this or something else, more of the detail on the tariffs. We'll talk to you next time.